Okay, so we can move on with the game. Okay, so we can continue the game. So let's go straight. I'll cite some nice illustration in here, and then you see. Now, development costs need to be capitalized. The accounting treatment of development costs. The accounting treatment of what? Development costs. That examiner, that accounting treatment. How do you treat development costs? It must be capitalized. So all development costs that meet the recognition criteria must be what? Capitalized. So development costs need to be what? Capitalized. So capitalized as what? Intangible. So development costs need to be capitalized as what? Intangible assets. If it meets certain condition, if the following conditions are in place. So before you capitalize intangible assets, make sure that the following conditions are in place. The conditions are 6 in number. So look at the 6 conditions, all of them one after the other. There are 6 specific conditions or rules that need to be before you can capitalize what? The development expenditure. So take note of these 6 conditions. Okay. So let's go through the condition one after the other. The condition. Good. Now this condition, we can use an acronym for it. It's a combination of the first 2 that we look at for. The combination for the first, so third examiner, conditions or criteria that need to be satisfied before you record what? Development costs as what? Intangible assets. Okay. So the condition, I've grouped them, I will call them pirate. Like this. So we should know the meaning of all of them. Here, probable. So this refers to probable. It must probable, or before recorded, it is probable that there will be what? Outflow of future economic, inflow of future economic benefits. That is it. It is what? Probable that future economic benefit will flow to the entity. So before you can capitalize the the development cost as intangible assets, make sure that it will bring some money to generate inflow, meaning that the asset will meet its commercial substance. The asset will be probably disposed of or will be sold in commercial quantities, or there's an active market for these assets. I get it. You have an active market for this particular asset. So probable simple means it will result in what? Inflow of future economic benefits. And then there's active market. If there's active market, meaning that there will be inflow of economy. So the P simple means probable. As usual, when I mention probable, probably you are not new to the word probable, right? Then I, intention to use or to sell the assets. So intention to use or to sell the assets. So like intention to complete the asset and use it or sell it. So do you have the intention to finish? Some organizations just develop products just for development's sake. Oh, we have a lot of products in the pipeline. They don't intend to what? Complete it. So intention to complete the development and what? Use or sell it. Perfect. If you don't have the mindset to complete this thing, something that, oh, every day I'll develop, I'll never produce it, to just pile up cost on my balance sheet, no. Then the R refers to availability of what? Adequate resources. Availability of adequate resources. Do you have enough resources to complete it? So the availability of adequate or technical or financial or other resources. For instance, do you have enough money to continue to spend on the development? Or for the first 3 months, yes, but for the next 3 months, you can't. No. If the resources are not there, these resources, there are so many types of resources we are talking about here. You can talk about technical resource, expertise, skills, financial resource like money, amounts, funds. Funds are not in to finance the development cost. So we started and we stopped, abandoned projects. The A is the ability, your ability. This is ability to use or to sell the item, to sell the intangible assets. So ability to use or to sell. Then let's go to technically feasible. Technically feasible. That is a T. Technically feasible. Technically feasible or technical feasibility. Feasibility. Technical feasibility. Meaning that looking at your current situation, is it feasible for you to complete the intangible asset so that you can use it? Let's assume that the COVID-19 team of some of the African countries, they say they are developing a vaccine. They are still developing it too. Let's assume that COVID is over, but they are still doing the development. This is not feasible because even to complete this game, the COVID is over. You are still developing the vaccine for COVID. Well done. Unless it's something that's come to public stay, and we need vaccination every year, go, that one, fine. But if it's just a one-time item that public came to visit us and go peacefully, then it is technically not feasible for you to have development after this illness. So that is it. The last one is expenditure can be measured reliably. Expenditure on this can be measured reliably. Expenditure can measure reliably. Have you seen these 2 points? They are the normal point. The first 2 points that we know under the assets recognition. The first 2 points that we know under the assets, probable that future company float entity, and then the cost involved can measure reliably. These are the 2 points. That means this point, then that point. The 4 points in it, they are the one that we have added. That is all. Okay. So we are done. Now let me cite a nice example here. Let me cite a nice example. And the rest, we are done. Let's with the question solving. Okay. Let's cite a nice example in here. Kindly follow me. Yes, I'm going to cite an example of research and development costs. And then the treatment of it, that's the aftermath of it. After development, how do you treat it? I'll explain those ones too with an illustration. So let's assume that Target PLC started a research and development into a product called Joy. This is how we started a research and development. We started it in January 2019, January 2019. And we spent at the research stage. So research started from here. That's where we started research. So let me write here research. And then we spent 1,000 Ghana cedis. No, let's make it $1,005. We spent $1,500 just to undertake the research each month. Okay. Okay, so we spent $1,500 on research every month. So per month. Then on 1st of October, we successfully finished the research and jump into the development stage. So I don't know how I shall arrange so that you will get it for me. So yeah, let me write research here in bracket 1,500 per month. $1,500 per month. And the development cost started from here. And we finished it the next year. Or let's assume that we finish it in December, 31st December. But development cost, at that stage, we spent $2,000 per month. So just research, let me write here, research is equal to $1,500 per month. And then at the development stage, we spent $2,000 per month. That is the development stage. Okay, full stop. Now, if I pass a note in the question like this, I pass a note 1. until okay, until 1st November, the directors were not certain. Sorry. Until 1st November, the directors were not certain that the product will meet its commercial substance. You see this note in. They say what? Until 1st November. So until 1st of November, the directors believe that the product will meet its commercial substance. All what they are saying is this: even though they have started developing the product as at 1st October, they were not certain that the product will meet its commercial substance. They are just telling that this product doesn't have P, probably it's not there. So let's calculate the research and development cost, and then let's pick it from the after. Now, research and development costs, you don't incur them at a go, one at a time, and step by step, as said, every month and past. So let's calculate the research cost here, development cost also there. So I'll calculate research here. So that exam, we are calculating the research cost here. Now, first, from January up to 1st October, how many months? January to 1st October. January to 1st October, how many months? So don't forget to count your fingers in advance. So January will be part 1. No, January, February, March, April, May, then June, then July, then August, then September. October is not part, right? October is not part, so September. So making what? 9 months average. So that would be from January up to September. That examiner that it should be 9 months, right? So 9 months, and they told us that each month is $1,500. So 9 months times what? $1,500, and that will give us. That is the research. So that should give us 1,500 times 9. That will give us 13,500. So the research is 13,500. Now let's see. And then they started the development as at when? October 1st. But they said until 1st November, they were not sure whether these products will be good. That's a game. That means even though they've informed us that they started development here, we will not agree because one of the 6 conditions has not been satisfied. P, I, R, A, C, and E. Pirate. Probable intention, resource, ability, technical, feasible, and expenditure. Now, until 1st November. So it means that as of October, they were not certain. So probable. Probable is not there. And once even one is not there, you cannot capitalize the development cost. So therefore, October's development cost must be what? Expense. It means that October's development cost need to be what? Expense. It must not be capitalized, but instead expense or add the research. So October's own, which is $2,000, right? Because for me going, they spend $2,000 per month. So therefore, the research cost was 15,500. So this becomes the total research. Third examiner, this must be expense in the P&L. That's the treatment. You credit your cash and debit your expenses because you pay. Good. Now let's go ahead and calculate the development cost. Development cost. Now, development cost, as we said, is application of a research finding. Don't forget that every development cost started from where? Started from research. And every good research, it must end up in what? Development. Okay, so that is that. Now let's calculate the development cost. So here, development cost. Development cost, tell the examiner that you move it from this angle. So October, we've moved October. So let me November and December. So November to December. And that will be 2 months, right? So 2 times $2,000. And that will give us $4,000. So that is all. What's the treatment? It must be capitalized. Capitalized means treat it as what? Intangible asset. Treat it as what? Intangible assets. That's the debit. That is all. So now we've gotten it. So now we call it what? Intangible assets. So now after getting it like this, then how do you treat it? After the capitalization. Now you have successfully capitalized it. If I should walk you through the stages, it's like this. These 4,000, you don't incur them at a go. This 15,500, realize I didn't incur them. It's a month by month. So every month, if it's qualified, we put it as like you are doing susu or monthly contribution. This month, I had 1,000, so add it to it. Come and sit down. Next month, 2,000, add it to it, add it to it, add it to it, until the entire development is completed. Then put all of them together as what? Total development cost. Then you push it into the account. Then you are done. Then come and sit down. So now we're able to get a total development cost and then total research. So now let's move on with the explanation. Now, after you have capitalized all the development costs, when do you amortize it? So check when the development is completed, totally completed, then you continue with that of amortization. Amortization simply means depreciating the assets. So condition number 1, before you can what? Amortize the deferred development expenditure, make sure that the capitalization is what? Completed. So completed must be here. Completed what? Or you have to complete the development. So when you are done with the development of the product, and number 2, commencement, start of commercial production. Start of what? Commercial production or use. Okay. So when these 2 conditions are in place, go ahead and amortize the developed expenditure or the developed cost. So the development costs need to be amortized over the life if these two conditions are in place. So development costs need to be what? Need to be amortized. So the deferred development cost, after you have capitalized it, and now you are done developing that product, and you've started the commercial production or commercial use. Maybe it was a formula that you developed. Now everybody is using it in a compound. Maybe it was a production technique that you have developed. So when you started using this technique in commercial quantity, so now the whole company, everybody is using it. Good. Start amortizing it over the life of the product. So when these two conditions are in place, then the development cost, in fact, we will call it deferred development cost, should be amortized. Amortized simply means depreciated. Amortized over the life of the product. So the product that you have developed, the formula that you have developed, if that formula will last for 5 years, then divide this 4,000. Where is the 4,000? Here is it. Divide it by the life of it. That is all. We are done with the recognition. And we've talked about the 3 items in summary. Can you take note of these 3 items? They are the ones that make intangible assets so interesting. On that note, we are done. I will now complete the game. I mean, I wrote plenty items on the board. So I'm now going to complete them. Now we go to measurement. Measurement. Go to measurement. Measurement means how do you obtain the value of intangible assets? How do you obtain the value? We have initial measurement. But almost all initial measurement is at cost. So here the initial measurement is at cost. Initially, all development costs or intangible assets need to be what? Measured at cost. Then we have the subsequent measurement. Subsequent measurement. That one, there are 2 models. You choose one. Choose the models that you have the cost model. Then we have what? Revaluation model. Now, what happened is this. All this measurement is basically the same as IAS 16. Whatever IAS 16, we did there, the same thing. So here I'll not even go into detail again. Can you refer to the IAS 16? Whatever we did under measurement, everything under measurement. So that means you can have a revaluation for that of what? Intangible assets. You can revalue them. You can also decide to use the cost model. So take note. Everything that we did under the cost model, basically the same over here. That's not changing anything. The only difference is what you look at for the 3 items. Number 1, number 2, number 3. In short, purchase intangible and then internally generated intangible. Then we look at the intangible assets with definite and then without definite life. Then we look at the research and development costs, how it must be treated. So now we'll look at the last section of it to end the game. The rest is question solving. Or we'll look at the question solving again in probably our next meeting to finish the IAS 37. Okay. So our next One will be the disclosure requirement of the intangible assets. The disclosure, what must be disclosed of the intangible assets? What needs to be disclosed? Now, the intangible assets are the disclosure. Now, you have to disclose the useful life of the assets, whether they are indefinite or they are definite or indefinite. Good. So kindly states the disclosure requirement. So disclosure, what must be disclosed as intangible? Number one, tell us the useful lives of the assets. The useful lives of the assets. One, whether they are definite or finite. Number one. Number two, indefinite. This one, tell us the rate. The rates. That's the first one. Number two, tell us the amortization model. So this one we A and then B. This is number one. Disclosure number two, tell us the amortization method. Amortization. Disclose the amortization method. That's the method of charging depreciation. Amortization method. Disclose it. Then you can also disclose the gross current amount. Disclose the gross current amount. And then you have to also disclose the current amount at the end and then at the beginning of the year. And you have to also disclose any impairment loss charged against and any increase in the assets. Good. So in short, number three, a lot of stuff go in there. Tell us the current amount of the asset at the beginning or at start, and at what? The end, at start and end, giving reference to the following item. Number one, impairment, any impairment charge. So disclose any impairment charge in the books for us. Tell us all the impairment charge against your profit or loss. Tell us impairment that you have reversed. Any impairment loss which has been reversed. Tell us the amortization. Talk about it. The amortization itself, the amount of amortization. Tell us increase or decrease in intangible. Have you added any intangible? Have you acquired any intangible during the year? Have you capitalized any intangible during the year? Kindly tell us in the form of notes. Oh, we had a new development and we started capitalizing it and we had this so far, put them in for us. That is the good. Now, we are done. There was something that we have to look at for. I think I'll do that. Now, what happened is we have the classification of what's intangible, the examples that we gave. So I'll add more story to it to end intangible assets and quickly start with provisions, IAS 37. so that in our next meeting, we probably kill it with what? More deadly questions. More deadly questions. So let's look at the examples or the classification. You know, assets are, in our books, we group the assets in classes. It's like all those that exhibit a particular features one side. So all those that look like vehicle, one side, tricycle, motor vehicle, or anything that look like a building or land, one side, land and building, or land or building. So it means that if you have something like a long vehicle, truck, or a trailer, and then you have a saloon car, all of these are in one class. So if you have a truck, cargo truck, and you have a saloon car, all of these are motor vehicles. They are in one class. Put them together. They are in class one. Good. So that is it. So I'll list some few classes of these assets for you. So the classes there, we have one, we have brand names. So the classes, brand names. Brand names. So the classes of it. So classes of intangible assets, brand names. Wow. Give me one brand name that we have in Ghana, and that of South Africa, and that of Uganda, and that of Sierra Leone and Philippines. We do have brand like PZ Heavens, Ozo's Chemist, JM Ado and Sons. They brought what from first 400 in Sonsuna for great. All these are brand names, and they are what? Intangible assets. Your brand. Someone cannot say your brand. And publishing title. Masthead and publishing titles. Masthead and then publishing title. All of them are in there. I'll talk about computer software. Computer or software. Take notes. Some of the softwares are inbuilt. License and franchises. License and franchises. So franchises, those are example. So they are in the same word category. License and franchises. And so it also talks about copyright, patent, and other industrial property rights. So can talk about copyright. Copyright, like a logo. Copyright. Patent. Patent and other industrial property or industrial property right or intellectual property right. Yeah. Good. Now the next one talks about recipes. Recipes, formulas, models, design, prototypes. All this one in one category. They are what? Intangible assets. Recipes, formulas, models. So something like Argentine model, Venn diagram, pi r square. All these ones are formulas designed by someone. So that person's property. So that's why we call it John Venn. Professor John Venn Venn diagram. So formulas. So you can also develop your own formulas that you can call it, name it, and then go and register it. Currently, I have one that I want to register. Help me register it. It's going for rats. It's a formula. It says that you want to answer any examination question on this earth, please read the requirement first, the additional information, and the trial balance or the financial statement. So rat or RAF. I developed this so many years ago, how to answer questions. I have a full meaning of it, that I've not registered it. So anybody can bring it. But it's yet to be registered. Good. And very soon you see it in the books. Yes, using how we have APA style. American Association of Psychology, probably their style of reference. The same thing, we also have target question solving principle, right approach. That's a formula. Examples. Okay. Then finally, we will have what you call intangible asset under development. Under development. On that note, we are done. So I'll quickly scan through some few questions and then you answer them for me. So just be patient, give me like 5 minutes. Let's scan through these questions. So question 1, I'll project it. Then you tell me your answer, questions solving stage. Okay. Start work. Now let's see. You have the Delali. Delali limited adopt revaluation model. Okay, this particular question. Revaluation model. Let's do something here. I think it should be a trial. Revaluation model. I intend not to do that one now. So I think you take a screenshot of it and do them later. Though I'll produce a solution to you. Good. So here, with the revaluation model, we just have to follow the revaluation principles. So that is a good game. I think these ones, I'll solve them a very nice section. Let me see here too. Okay. This is intangible assets. This one. Move on here. Okay, we are searching for it. Okay, that's a nice question here. Okay, so now tell me how we should account for this. And this is very interesting one. Yes, so I think we can do it. So intangible assets consists of capitalized development cost of 30 million. They capitalized 30 million. This relates to products in development. They are still developing the product. at April 1st, 2017, no revenue has yet been earned from any of these products. That means we are yet to produce them, right? Okay. They are all expected to be successful once they are ready, for markets. With the exception of one project, the amount previously capitalized in respect of this project was 6 million. However, adverse development has led to the decision to abandon the project as it was unlikely to be successful in the marketplace. Fine. During the year, further expenditure was incurred on qualifying projects and was charged to administrative expenses. The amounts are as follows. So, prototype development cost 3 million. Marketing research to determine the optimal selling strategy. Basic research, which may lead to future projects, 4 million. And this they've mentioned here. Tell me which of these three, which of them will be a research, which of them will be what? Development. That's what probably I'm interested in now. For the full one will be solved again. So now, friends online, tell me how we should do this. Product development cost. Does it qualify to be a research or development cost? Research or development cost. So tell me out of this, now the mistake that is they put all this cost in admin cost, administrative expenses. You know that only research should be expense. If it happens that some of these costs are development costs, it's a lie. It's not expenses. So tell me the research ones and tell me the development ones. Okay, so first online, waiting for your answer and then move on. So prototype would be development cost, because they say development cost, prototype development cost. Market research to determine optimal selling strategy. Well, that should be, that is a research. Basic research which led to future projects, it's also a research. So hence 3 million should not be what? Expense. It must be capitalized. So 3 million must be capitalized. That is what we have to do. 3 million have to be capitalized. So, and then we look at it. What about the 1 million optimal selling strategy? What about optimal selling strategy? How do you treat that one? So yeah, what they're supposed to capitalize the expense. So now what do we do? Take it from admin. Credit admin, meaning take it from administrative expenses. It is wrong for them to add a development cost to admin expenses. It's totally wrong. So now you have to do the right thing for them by taking it off from admin, by crediting admin to reduce the admin figure, credit it, and go and debit the development cost itself. How we get that? Yeah. And then that is all. Okay, so that is that. Oh, friends online, today the basic research, how are you going to treat that? Basic research that we've explained that to. basic research. Okay, friends online. Okay, don't worry. One, in short, I mean that prototype development costs need to be capitalized. There is market research, basic research, don't need them. They're already expensive. That's good news. This one we will not agree. I'll choose one on our next meeting. And then this, yeah. Let's see if we can get another question again. Do justice to it. I have one last question that we look at for. One last question that we look at for. One last question we look at for. Okay, so let's see here. I have a question here. Let's look at May 2010. There is development cost somewhere. Hey, what's happening? Sorry, let me open the book. May, sorry, this section. It's coming somewhere on the screen. Let's use this. Let's use this. File. Let's use. It does not have any issue. Okay, there's a question in here that we have to look out for. Now let's start with non-current assets, intangible. In addition to the capitalized development expenditure of 10 million, further research and development costs were incurred on a new project, which commenced on January 1st, 2009. The research stage of the new project lasted until 31st March 2009. How many months? Calculate for me. Okay, and incurred 0.7 million of the cost. Okay, so 0.7 million out of what the 10. Okay, so 0.7 million. That's 700,000. From that date, the project incurred development cost of 400,000 per month. So for March, on July 2009, the directors became confident that the project will be successful and yield a profit well in excess of its cost. The project is still in development as at 31st December 2009. Capitalized development expenditure is amortized at the rate of 20% per annum using the straight line method. Oh, this example is very good though. All external research and development costs is charged to cost of sales. Okay, good. Now let's see something here. Tell me the development cost in here and tell me the research cost in here. That is all. From this information, what will be the research, what will be the development cost from this information? Start work. Let's work out together. Now, in addition to the capital development cost of 10 million, further, let's go to the balance. intangible asset, capitalized government expenditure, 10,000 is here. Okay. So they started in 2009. The research lasted until 31st March 2009. So that one is 700,000. So this must be expense in what? The P&L. They say it must be treated in the cost of sales. So add it to the cost of sales. That is what it informs us. Okay. And then it continued again. From that date, from which date? 31st March. So indirectly from April. 1st April 2009. From that date, the project development cost of 400,000 per month. On 1st July 2009, the directors became confident. So first was July. So it tells us that until March, they were not so sorry, until July, they were not confident. So even though development started from April, May, June, those one we can still do what? Expense them. And we have to start capitalizing from where they are what? Confident, where they are probable, feasible, intention to finish is there. How we get it? So that means we need to move from April, May, June, 3 months of 400. That will be 1,200 must be added to the 700, making 1,900. So that is the treatment. So the research cost here will be 1,009, not 700. Then they said that the project is still in development as at what 35 December. So still continue capitalizing until you are done. You cannot amortize continuous development cost. No, you can't charge depreciation. So all what we have to do is, if you want to calculate development, you start from where? July up to December. So from 1st July to December is how many months? 6 months. So 6 times 400,000. 6 4 24. That will be 2,400. So that's 2.4 million. That's the development cost. That is all. Good. I'll solve this question fully again. Probably in our next meeting. I'll get all those questions for you, and then you'll be fine. Okay, so basically, that is the picture of the game. That is the picture. So in short, 2.4 goes to government costs, and then you now send 1.9 to cost of sales. And again, the existing ones need to be what? Amortized. You only amortize the existing government cost of what? The 10,000. So far, they amortized your 3,000. So you basically add it to it to complete the game. Okay, so that is that. Okay, then let me look for the last question. Engineering Limited, through a research project, discover an innovative formula for producing its products that reduce cost by half. Below is an itemized list of the costs incurred by producing by the company in coming up with a new production formula. Cost of research. Cost of research on possibility of new production formula. 20,000 cedis. Cost of material for testing different formula. Cost of pilot new formula. Cost of registering rights over the new formula. Then that is all. So tell us, out of these four costs here, which of them will be research, which of them will be development? So I need this one before our next meeting. Just group them, only four. Group them, research one side, all development costs one side, and tell me the treatment. That is the question of the day. Okay, great. That is the end of the game.